Hello and welcome to We Mean Business. India's car sales have crashed by 26% in February, the biggest fall in more than 12 years. High interest rates, soaring fuel bills and a general sentiment of gloom and doom seem to be making consumers stay far, far away from those showrooms and give car makers sleepless nights as they battle shrinking volumes, squeeze margins, high inventories and production cuts. On We Mean Business tonight, we take stock of what's gone wrong with India's automobile market, how much worse things could get from here, and what the implications of the slowdown are on suppliers, on labor, and on the economy as a whole. Joining me is a very special panel indeed. Lowell Paddock, President and Managing Director of General Motors India; Vikram Kirloskar, Vice President of SIAM and Vice Chairman of Toyota Kirloskar Motors, joins in from Bangalore; Abdul Majeed, Waterhouse Coopers, he's a partner there; Nishant Vass, Research Analyst, Auto and Ancillary at ICICI Direct, and our in-house expert, Siddharth Vinayak Partnerkar, Editor, Auto at NDTV. We'll also speak later with HS Goindi, President Marketing at TVS Motors, for a perspective on the two-wheeler market. I want to begin with you, Mr. Kirloskar. Every time we take up this subject for discussion, things only seem to be getting worse. How much of a further pain are you really expecting in the auto sector before actually things start getting better?
You know, I think this year is going to be a really tough year. The kind of sales that were going on in January and February, the reduction in sales was sort of unprecedented. I don't know what it is. It's the sentiment, it's the interest rates. I think we are an overtaxed industry. In the price of a car, almost I think 80% over the cost of the car are the taxes. We're just sort of pricing ourselves out of the whole thing. And this is a very important industry in terms of the manufacturing sector. We lead the manufacturing sector, 25% of it. And we also generate the jobs required for the manufacturing sector. I think we have to wake up on this whole industry.
Right, but you know, SIAM hasn't officially put out its targets for next year, sir. But given that you've said you'd be missing the 0 to 1% target as well, what should we be potentially looking at as far as FY14 is concerned? Would it definitely be negative? Would it be in the upper sort of negative band? What's the sense?
I think in the car market, at least, if we can match last year's numbers, we'll be lucky. Unless something really dramatic happens in the middle of the year, dramatically the sentiment changes or the interest rates really start coming down a few 100 or 200 basis points. If some of these things do happen and the economy really picks up, we see literally a flat year.
Right. Mr. Paddock, March is usually a good month for automakers. Are you expecting a bit of a reversal, or is this going to be an aberration given the environment that we're talking in?
I think Vikram is right on target. I don't see anything right now that's going to drive us to a dramatic improvement in March. I think there's a sentiment issue. There's a wait and watch driven by interest rates, and so I don't see any particular driving factor that's going to generate a lot of movement. And you've seen certainly in the last few weeks very substantial movements on pricing and offers, and even that still hasn't stimulated demand. So we look back to March of last year, a very dramatic and very healthy market, and this year is something entirely different.
Right. Abdul, you know, Mr. Kirloskar spoke about the need for a pickup in sentiment. I mean, consumer confidence, like we all know, is at an all-time low. People are not sure about their jobs. Salaries are stagnant. Inflation continues to remain high. All of this is going to take time to fix. So when is the recovery going to start? Are we at a cusp of a recovery, or is this going to be a protracted sort of U period, and we probably see a recovery only in the second half of this year?
I tend to agree with the other panelists. I think right now the sentiments are so negative. Especially what happens is that when the customer wants to buy, they look at the cash flows. And looking at the cash flow, the inflow is not too certain in terms of increment, in terms of bonuses. Interest rates are pretty high. The fuel cost, the cost of maintenance is very high. And also liquidity is not really there in the market. I think people are not willing to give the auto loan. So taking into account all these things, customers are just trying to push forward the buying decisions. So I don't expect anything to happen in next 6 to 9 months the way things are happening around. If something happens dramatically, I think probably in the September and all, we can just see some sort of a growth. But at this point in time, it's very, very uncertain. And also down the line, I think there are a lot of policy paralysis. I think we're just kind of send a very confused signals to the customers, diesel versus petrol, so all those sort of things are just putting, kind of a negative sentiment on the customers. And then also there is going to be general election in 2014. So look at the environment. If I look at all environment, there is no single kind of sign which looks to me that something is going to happen, in 13 also.
Right. And Nishant, do you agree with that? Is the environment getting more and more uncertain, and has the budget in some sense only exacerbated the situation with the whole SUV tax and so on? What's the sense? Is the environment for the auto sector as a whole not getting conducive anytime soon?
See, the auto space witnessed a significant correction in the last couple of months, because in anticipation of a strong Q4, that typically is a seasonal thing, the automakers built up inventory. So that didn't pan out, and it is leading to all the stuff that we are seeing right now. This is majorly due to the high base that we are sitting on in the Q4. I completely agree with the panelists that overall the sentiment is negative, but this sentiment or the interest rates or the prices of petrol and fuel have remained similar for last around 6 months. So it is just maybe a culmination of many factors that you are seeing at right now, with the volumes coming down 26%. However, we believe that by second half of the next financial year, couple of things would happen. There would be significantly lower bases of the cars that are already in the market for this year. So you would have a low base effect, and also if in the first half you see some rate cuts or some policy actions, you might see some demand reviving back. Along with that, new product launches that would happen typically in and around Diwali would also help in pushing up some sentiment. So I think all in all, it's pretty grim for the first half, but however second half we are a little bit more positive.